Hi, I'm Adrian Walker, and we're doing a little something different for the Walker Report. Oil prices have defied everyone's expectations and essentially collapsed over the past year, hitting their lowest rate since 2009. There are some analyst expectations about what a realistic barrel of oil should cost, but over the past few months it has become clear that we have no idea when a fair price will be reached. Now, with some analysts predicting a $20 barrel of oil, the consensus is that oil will be lower for longer. Why is that? The standard story is between two nations, the United States and Saudi Arabia. Over the last few years, the United States has once again become a major producer of oil, using new and increasingly cheap methods of sideways drilling to extract shale oil. Commonly known as fracking, it has garnered some negative press, but the sheer abundance and cost-effectiveness of that oil is too tempting and has flooded the market with crude, driving down the price and potentially making America a net exporter of energy. In the other corner is Saudi Arabia, the traditional swing producer for OPEC that has long been responsible for keeping the price of oil at a certain level. But with time comes experience, and the Saudis are wary about allowing the fledgling American producers to gain significant market share. In the past, when Saudi Arabia has cut production, it has had to give up its market share, and it doesn't really want to do that anymore. It's no longer satisfied with that role, and Saudi Arabia has continued to produce oil unabated and allowed the price to continue to fall. But is that the whole story? Not exactly. One of the key reasons that oil will be lower for longer is because this is about more than nations sparring. This is a story about new disruptive technologies versus older traditional businesses. Traditional oil extraction is a significant undertaking. Locations are often remote and geographically difficult to access. Usually no one lives anywhere near where these projects will develop. Making a big energy program happen often means big commitments to infrastructure, large capital requirements, laying a huge geographic footprint, and a long time horizon before returns are realized. In other words, big, expensive, and difficult. As an example, here are the tar sands. Essentially, one giant open-pit mining operation, the tar sands are located in the remote northern region of Alberta, 400 kilometers north of Edmonton. Roads, electricity, people, food, hospitals, all of it needs to be imported and built to allow these projects to continue. And that's all before you've refined a single barrel. This project, the Gorgon Gas Project, is located 130 kilometers off the coast of Australia and is a subsea natural gas project. What you're looking at is the liquid natural gas facility, or the LNG facility, built on Barrow Island, and it's the largest natural gas project in Australia's history, and is aiming to tap into over 35 trillion cubic feet of natural gas. Kashkin is the world's most expensive oil project, costing in excess of $116 billion. This North Caspian Sea venture represents one of the largest oil discoveries in recent years, making the presumably inclement weather, isolation, and costs worth it. The Australia Pacific LNG represents another Australian liquid natural gas mega project that's due to open in 2016, already being signed contracts to sell natural gas to both China and Japan. And I think many people would say they're familiar with the challenges of offshore drilling, but like many onshore projects, it is expensive, it's remote, and it's dangerous. And if you've forgotten about how bad it can be, simply Google BP Horizon oil well to refresh your memory. In addition to all those challenges, oil development also goes on in many parts of the world where political turmoil and terrorism are regular problems, and they frequently incur warranted criticisms on their environmental and humanitarian impact. Now let's look at the new technology that is being used for horizontal drilling. This is a map of the Montney Shale deposit and the land currently under development by Advantage Oil and Gas Inc. It's located in Alberta. This project promises to have more than 1,000 wells in just the Glacier gas plant ultimately. But notice the geographic impact of horizontal drilling. Compared to similar large projects, the Glacier gas plant sits on about 2 acres. It has room to expand but doesn't need to move or dramatically increase its size, allowing it to take advantage of the existing infrastructure. And using new technology, it can efficiently and cheaply tap into shale energy, making it highly competitive against traditional energy projects. Quadrupling its capacity also doesn't mean a vast expansion. The smaller footprint of this type of drilling means less costs overall. Big expansion in return doesn't mean big expansion in size or capital. All of this technological disruption is leading to lower oil prices. And while we may be excited about cheaper gas and lower costs of things generally, there are some very real downsides. First, this is largely a war of attrition, and ideas and plans that seem sensible at $100 a barrel seem less so at $37.50. Many of the companies that have made the shale revolution possible are saddled with debt that was manageable at higher values that is becoming increasingly burdensome and threatens to put many companies out of business. That's true for traditional oil producers in the Middle East as well. Countries like Saudi Arabia have actually gone into debt this year, and Saudi Arabia itself has huge costs right now. It's spending big money on weapons for its military and is currently waging a war with Yemen. The cost of cheap oil is instability in many places. In Canada, we tend to think of the three main industries here as being energy, financials, and materials, or oil, banks, and mining. But there is a large connection between them. As oil prices fall, much of the debt and investment that weighs heavily on existing projects is connected to the banks. Projects that either default or close shop represent real losses to Canadian financial institutions, let alone the larger risks associated with slowdowns in the Canadian economy. Other oil-producing nations are also suffering. Venezuela, Russia, Brazil, Mexico, and Iran are all countries that rely heavily on good oil prices to cover running the government. Low prices in oil are effectively bankrupting those nations. Russia reportedly needs a break-even price of $90 to cover its costs. Iran, more than $100. But the real threat here is undoubtedly deflation. Deflation usually means falling prices of consumer goods, but it can also spell disaster for an economy. Falling costs make it harder to raise prices, margins get squeezed, and invariably, companies trying to prop up their share prices will pursue things like layoffs and cost reductions. Deflation also magnifies the impact of existing debt. Prices, wages can both fall, but debt levels don't. So as the wages fall, your debt actually becomes larger compared to what it used to be. Cheap oil carries some obvious benefits, but those benefits need context. The global economy is still quite weak. Deflation fears are widespread, and interest rates are at historic near-zero levels. Low oil prices in this context means more volatility for global markets, not less. Lower for longer makes some sense when we look at the underlying technology that has allowed the world to be flooded with cheap oil. From the perspective of traditional oil producers, especially that of the Saudis, pushing the price down regardless of consequences may be the best way to stave off an incursion by shale oil and retain as much market share as possible. The short-term pain is great, countries and economies are suffering, and global balance sheets are being ruined by the decision. But keeping the status quo and remaining the swing producer probably means long-term loss of business. But if you were a producer in the United States, right now it probably seems like a good idea to keep fighting it out. Costs for fracking are low and dropping. It is easy to start and expand a series of new wells, much easier than comparable mega projects. Your energy is getting cheaper, and while costs continue to drop, the technology for retrieving oil continues to improve. Saudi Arabia may hope to drive shale producers into the role of swing producer, but taking stock of the situation now, it looks too early to throw in the towel if you're using the latest, smartest, and cheapest technology. So that's the end. Thank you very much for watching. If you have questions or comments, please email them to me or leave them here on our website or on our YouTube page. Also, we are asking what you'd like our next video to be on, so please don't be shy and send in your thoughts. Of course, you can follow us on Twitter or find us on Facebook. And thank you very much for watching the Walker Report. I'm Adrian Walker. It's December 10th, 2015, and I look forward to seeing you in our next video. Thank you very much.